And so we talked about, and I think it's a fair assumption that volatility will continue. I mentioned some of the upcoming catalysts we shall see. Um, and so when there's a lot of vol, I assume the option pricing improves. I mean, maybe for our audience, just talk about taking advantage of vol. So we first recognize we'd like to reduce concentration. We may have a point of view from a timing perspective. It could be pre or post earnings or other conditions. But are you seeing the options market um, price accordingly? And is that to the advantage of your clients?
Very much so. The options market is always going to be a market that is reflective of the expectations of sentiment, volatility, of fear, of greed. Effectively all at the same time, especially when we get these large, large expansions of volatility as we saw in the last few months. And our point of view, volatility equates to opportunity because volatility works in both directions. And so what that can be very helpful for is that if you've just seen a stock decline, as we did with a number of most of the more prevalent names here in the last few months, when we typically see those rebounds, remember, can happen just as sharp, just as short, just as sweet. And what we tend to do with those rebounds is to begin to look at what an appropriate exit price could be, knowing that as markets decline and they begin to rally, and we've seen here for the past few weeks that the rally wants to continue just as if it never had stopped in the first place. And so as we see stocks begin to rally back up towards or even into all-time highs, that begins to really set for that conversation that says, well, if you would have gone back in history and said, I wish I would have sold here. Well, if you got that price again, maybe it's time to revisit that, knowing that what we're not likely to do, and I think what our collective opinion is that we're not likely to see a sudden surge of volatility and then a continuation of more like we saw last year in 2024, which is that all stocks go, as we like to say, from the lower left to the upper right on the chart. So volatility is an opportunity set from our perspective, and depending on the source of a concentrated position, if you're still employed with the company that you work for, you may be restricted into some of the considerations from what we call our concentrated position toolkit. But nevertheless, that's part of the conversation we want to have. And if you are restricted from participating in any type of option market volatility, then simply looking at how that translates to stock prices may be the most valuable thing for that particular client at this particular time, especially as we head into a summer that has a lot of unknowns, a lot of the tariff talks that have been somewhat sidelined. We don't know when they're going to come back. We don't know how they're going to come back, but it does maintain that if that, again, kind of reiterating what we mentioned earlier, that if you didn't like what you saw and how you felt, especially when it was something, an external an external stimulus that was impacting your stock price and not necessarily the success of your own company, that begins to trigger that conversation as well as to do I feel comfortable with this, or is it time to even consider even a small allocation shift. It could be 5 or 10%, but those 5 or 10% position changes tend to add up over a period of years that we think is all part of that very valuable conversation as we help clients to kind of take a set a roadmap for where they want to head next.